Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to the final episode of Stocktake for 2025. My name's Gaurav Sodhi. Joining me today is a bit of an ensemble. I think we've got everyone today. A special guest, my boss, the very handsome Nathan Bell. Hey, boss, how you doing?
Have you not seen the webinar lately?
I thought in case you're still signing Christmas bonus checks that I'd just throw that in there for you. Maybe you won't forget.
You've been here long enough to know better.
Welcome, Nathan. Good to have you on finally. Joining us also from Newcastle is Nick. G'day, Nick.
G'day. How are you guys?
We be well. Graham from Vancouver is here. Jesus, 4 of us. Hey, Graham.
Hi, Gaurav.
And unfortunately, John is a little unwell, so he couldn't join us, which is why we've hastily arranged this rabble. You have to forgive us for the impromptuness of this podcast. But gents, it has been quite a year. 2025, it's all coming to an end. I reckon this has been... I was actually very happy with how this year ended, considering how many bombs have gone off in the market, how difficult it's been to find ideas and to navigate past tricky situations. Nath, as PM, would you agree with that assessment? Has this been an okay year?
Yeah, last year I was just tearing my hair out. It was so frustrating. But I felt, obviously my view is always a bit biased towards the funds rather than the subscription business, just because that's what turns my hair grey. It's the funny thing about being a value investor and a professional investor is that you're trying to build portfolios for the next 10 or 20 years, and yet your performance is judged every 4 weeks. And I've actually felt very strongly that our stock picking has actually been really good over the last probably 2 years at least, but we just haven't been getting the benefit from it. Mineral resources was really tough going through that. But the other thing was that it's the index itself that you're getting compared to all the time. And I just don't understand people's view that they think that the market is priced at fair value when 30% of the index is made up of banks that look drastically overvalued to me. But they're 30% of the index and they're all up, sort of on average about 60 or 70% over the last 2 or 3 years. And we've had to compete against that. And if you look at any of the statistics for the ASX, but also in the US, it's just been a very small handful of stocks that have produced all the gains. So finally, we got some reward in the second half of this year. So for me personally, and for the funds, just where I was at, mentally last year, and the frustration, and this last 6 months in particular, absolutely chalk and cheese.
Yeah, no, I agree with that. Graham, you might have a different view. You've actually been at the receiving end of a lot of the bombs, actually. Covering healthcare in particular has been tricky. What would your assessment be?
Well, yeah, it's been a minefield this year for healthcare. CSL is the big one of the biggest companies.
Isn't it? Just think back 5 or 10 years. Who would have thought CSL would be the problem stock? Yeah,
and just the scale is incredible. So for such a large company, it's down 40% or so from its highs. That's $60 billion wiped out of the market cap. So a huge amount of, not necessarily value has been destroyed there, but all of the investors would be feeling it. And but management has just done some really strange things over the past couple of years, so I can also understand the decline. They've been, just haphazardly talking of spinning off Securus. There's been these cuts to research and development. Another big one is that margins for the bearing business haven't been recovering as fast as I think most people were expecting, and management was sort of pitching at least a couple of years ago coming out of the pandemic. So, when you kind of wrap it all up, it's been a lot of hot potatoes for CSL and healthcare more broadly with all of Trump's funny business in the US.
Take CSL to one side, and what about the rest of the sector? I mean, we've had some success with ResMed. Sonic has been frustrating. I mean, the sector has been difficult to navigate.
Yeah, it's funny though. Sonic is up 15% in a month or so. So that's one of those examples where maybe it has actually bottomed and the fear around it is starting to subside and people are starting to look through at the the pretty strong base business that's still growing in the mid to high single digits. That's well above what it has done historically. So I think pathology in particular has been kind of a hidden gem for the healthcare sector at the moment, where it's been kind of ravaged after the pandemic. It had all of these issues as the COVID-driven revenues rolled off. But now I think we're starting to see the proper Sonic that was always there underneath. And that business, I think you can argue, is in a better position now than it was 5 years ago. So I'm hoping that this little rage of excitement over the past month maybe continues with the new CEO starting next year.
There's a bit of karma here, because when I became research director back in, 2014, I handed off all my healthcare stocks to Graham, and he lived on the glory for the next 6 years. They were the market darlings. They were the stocks that everybody used to want to own. Fish and Paykel Healthcare and a whole bunch of others. They were just the red hot stocks for probably a decade. They were the ones you wanted to own. They were just so predictable and kept growing really fast. I think CSL went up tenfold there at one point, and now there's a little bit of payback. But it's interesting that it's not just an Australian phenomenon. Healthcare has really been hammered hard in the US as well. And so it's interesting. You can look at some of these businesses and see that there's company-specific things, but there's a real general move away from a lot of these healthcare companies, and they're struggling against, I think, the size they've got to. They just, victim of their own success. I think regulations have changed, margins are under pressure, and I think the part of it is also just costs have increased across the board. It's hard to find people. I don't think there's hardly a healthcare business out there that's not complaining about the cost of staff. And at the same time, they're trying to let people go, but there's only so many people you can let go in these businesses. And I saw just one little anecdote in there that to show you how frustrating being an investor can be is, and again, the lesson really is to keep things simple. But since I came back to the business in 2018, I've kept a hedge, what I call a hedge position in CSL in the model portfolios. So we've had it was 5% on average position in there. So my feeling was I was worried that CSL could be a stock that the market would end up paying a crazy multiple for, and I didn't want to be underweight CSL. I was happy to hedge that out because it's been such a great company. And it turns out I picked the wrong stock starting with C. It was Commonwealth Bank that we needed to hedge, and not CSL.
Well, I'll say this for the sector, that it did produce one of my favorite recos for the year, which was Helios, which we'll get to maybe later on, but we haven't heard from Nick yet. Nick, you've got a unique perspective because you're focused on international stocks, and of course you notice what's happening locally as well. Is there a divergence between the two that you've seen?
I wouldn't say there's a divergence. I would say, I guess, internationally speaking, that's been really a tale of two halves for us. The first half was reasonably good, and the second half, it hasn't been bad, but it's been a bit underwhelming. And what you're seeing, particularly in the US market, is just a narrower group of stocks day by day driving the market. And really, if you weren't involved in 3 trades this year, you underperformed. And those 3 trades were AI and all the CapEx beneficiaries from that, gold and defense stocks. And then more recently, which has been the bit that really icks me, is this sort of promotional dodgy small caps. So think like crypto, dodgy miners,
Drone Shield.
Yeah, anything related to nuclear power, uranium, quantum computing. They've just had this massive run in the last couple of months, and at the expense of actually quality businesses. So quality as a basket of stocks has actually had one of its worst years in the last decade. I actually saw a chart that suggests it might be the worst year quality stocks have had going back to 2000. And investors, I think, have got pretty used to some of these quality businesses doing quite well. So if you think about like payments companies like Visa and MasterCard, massively underperformed this year. And then more recently, some of the classifieds businesses, so REA and Car Group, Rightmove or Auto Trader in the UK, have really started to come back. But, it's the same in healthcare. It's a number of sectors. But that's, I guess, pretty exciting because there's a lot of opportunities. And most of these opportunities are being thrown up because of fears around AI. And if you've been branded an AI loser or a potential AI loser, particularly over the last 3 months, your stock price is down like 20%. But that's pretty exciting to me. We're finding a lot more opportunities. I actually think it's probably the broadest set of opportunities internationally that I've seen in the last 5 years, probably since COVID, actually. So that's the exciting bit, but it has been a bit painful seeing some of these, crappy stocks go up.
I think we called this earlier on in the year we had a podcast episode and certainly lots of internal discussion about quality being in a bit of a bubble, and on the ASX more than anywhere else, quality has just been phenomenally expensive and overbought, and I think very unattractive. My personal portfolio has looked pretty lousy for a little while in terms of the quality stocks. Until a bit more recently, when I think those prices have come off a little bit. What's been your favorite reco for the year, Nick? Let's just start with you. What's the recommendation you've liked the most? The idea that you've liked the most?
I'll just pick the one that's gone up the most. I'll keep it pretty simple. And that's Allfunds. So Allfunds is a European wealth platform, very similar to Net Wealth or Hub24. Essentially, what they do is connect fund managers to financial advisors, and with the markets at close or near, or at all-time highs, it's not a surprise that these wealth platforms have done well. Allfunds has recently got a takeover bid, and it looks probably a little bit, not the best price. I think they could have probably got a better price, but I think because they've got a private equity backer in there that needs to sort of cash out, that they'll probably end up selling that business and taking that offer. But for me, why it's been such a, I guess, bit of a relief is it's just done nothing for 2 years. And we've sort of just sat there watching it. Each year the earnings are up 5 to 10%. Or even higher. They're getting net inflows. Their market share is growing, but the stock has done nothing. It's just been really, really frustrating in an environment where the market has done quite well. So to have that turn around this year and to get a bit of reward was probably my most pleasing recommendation, I think.
Graham, what about you? I've got one for you. I think Helios has been. I really like that record. I like the guts it took to buy a stock that had done so terribly for so long, not just in terms of share price, but business performance, management, balance sheet. It all been terrible for a long time. So I like that you had the gumption to step up and speak for that stock.
Yeah, I definitely couldn't imagine recommending it 5 years ago. We had an avoid on it.
That's right.
And it goes to show businesses can also change, I think. Hopefully, it hasn't played out yet, but it looks like it's changing. I think my favorite pick would probably be London Stock Exchange by Nick. I think that was just a very clever look at a business that is disguised, and that there's a much better business than the boring kind of monopoly exchange on the outside that it looks like it's packaged in, but is actually just a small part of the business. So I think it's down a little bit since the initial review, but that's only made it slightly better value than before. So I think members can definitely take a look at that one.
Yeah, I was just going to say it's a very good example of what I was chatting about before, of one of these businesses. The London Stock Exchange Group is now just a data business. The actual stock exchange operation is about 3% of revenue, so you can absolutely forget about that. But it's pretty much a financial data business, and a lot of these financial data businesses have been high quality businesses for years, high margins, high return on capital, little need for reinvestment, and now they're actually getting questioned, or their market position is getting questioned because of AI, and I just think that's probably a bit foolish. I mean, London Stock Exchange Group did a sort of presentation on this where about 90% of the data they sell is proprietary. So it's like, well, where is this data coming from? And then on top of that, this is financial data. It needs to be accurate all the time. And I just don't know if people are going to trust AI to do this tomorrow. Plus, how do they get access to it when 90% is internal data? So it's one I'm pretty excited about, but hasn't done anything yet.
Oh, there's your package, Nate. Why don't you go get that?
Tsunami alert.
I've really enjoyed covering eagers, finding that opportunity and covering it. Sometimes you come across a business that you just know, right? And I've said this before, but sitting at that AGM, I knew within 10 minutes that A, I was going to buy the stock, and B, that it would do well. Like you just know sometimes, and it's rare, but when it happens, it's just glorious. And it happened with eagers, and we could not have been more enthusiastic in our recommendation. I think I called it the essence of value investing. Like I was so firm, had so much conviction, and when everything works out, it's just glorious.
Perfectly timed.
Yes, and when it happens instantly, that's even better. You got to really enjoy those moments when they turn up, because often it turns out the way MinRes has turned out this year, which is a stock that we've covered for a long time, understood really well. A couple of bombs went off that we didn't expect, and we stuck with it, and it's recovered back to sort of where it was just about a year ago. What a year! But the psychological turmoil that you go through with this business like that, you sometimes wonder if it's worth it, because it's been a very difficult ride with MinRes. But that's been one of my most interesting stocks to cover for the year. I have actually enjoyed the ride. I think it's been fascinating. But what about you guys? Have you had a MinRes? What's your MinRes for the year, Graham? Yours is probably CSL, isn't it? Surely.
Well, that's had a lot of down. CSL's been the biggest pain, but mainly because I think that it should be doing much better than it looks. There's things that are not ideal with it, but this is fundamentally a very important company, and not only Australia, but the whole world's healthcare system. Millions of people depend on it. It is not going to be dislodged from its oligopoly anytime soon in antibody treatments. And while the vaccine business is kind of struggling, the iron business is iron ore. I always say iron ore. Iron deficiency business is also under pressure. But like those are only a third of the overall company. That the main gem is doing perfectly fine. And so I think that maybe next year will be CSL's turnaround. We'll see.
Yeah. Okay. Nick, let me guess yours as well. Would it be Floor and Decor for you?
No, well, that was last year, and I will say, Floor and Decor, it's something we did actually pretty well. We actually got out with, I think it was we recommended $90 and went up to $110. We saw that a few things were changing. We put a sell on it, and it's now at $60. So we did that well, but I should have heeded a lot of those lessons, because my worst recommendation this year was Diageo, which we had a buy on.
Yes, Diageo. Yeah.
And then we switched it to a sell as we sort of saw the industry conditions were changing. So Diageo's the world's largest spirits manufacturer. I think they've got about 20% market share, just a touch over, and own brands like Johnny Walker and Bundaberg Rum here in Australia. And I originally saw, or what I thought I saw, was sort of a higher quality business that had been sold off because there was inventory destocking after a massive run up in COVID. I thought, well, once that sort of flows through, that they could get back to mid-single digit growth and sort of low teens profit growth. What I failed to fully appreciate was just how much this industry was changing and how much consumer habits were changing. And specifically that we're not drinking the same amount of alcohol as we used to. And I sort of knew that, but I thought that because Diageo has a premium portfolio, they could offset some of that volume loss with higher prices. And it just hasn't been the case. I also gave management, I think, far too much credit. They were pretty appalling, to be honest. Their expectations they gave to the market were just too inflated. I think my biggest lesson from that was a year ago with Floor and Decor, I noticed the industry conditions were changing and that Floor and Decor were really going to struggle in that environment. Whereas with Diageo, I sort of noticed it, but I gave management too much time. I just thought, maybe another call and they'll get it right. And it didn't happen. So I probably should have been a lot quicker to act. So for that reason, it's my poorest pick of the year. In terms of actual losses, I think we took about a 20% loss, and the stock's fallen another 10 or 15% since.
That is such a flex. If your worst loss is 20%, 20% is nothing.
Gaurav does that in a day.
That's
Yeah.
my daily move.
Yeah. No, well, it was just frustrating because I think I saw a few of these things coming. I gave management and the company far much more time than I probably should have.
Yeah, I think that was a classic value trap, wasn't it? In hindsight,
It was.
Always wary of big companies on low multiples. I think when a business is really well understood and it's trading on low multiples, everyone can see the low price. And
that was Apple 10 years ago. I remember when it was on an 8 PER,
and I bought then, Graham. But
do as I say, not as I do.
The end of that sentence was going to be: there needs to be an insight that you have that's very, very different to the market if you're going to buy a big stock on a low multiple. Like, you better know something about that stock that the market doesn't, or you better have a notion that is different to what the market does. And that was true of Apple. Apple. When I bought Apple, when my family, I guess, it was my wife who kind of insisted on it because she works there. It was because of the ecosystem. Back then Apple was a hardware business, and everyone thought hardware margins were going to crumble, and it was actually an ecosystem business, and they just got the business wrong. I think I was going to bring up Google as our most painful recommendation for the year, and I think the worst piece of work that we did all year was on Google, and I think we probably need to. We have done a little bit. We've sort of sat around and looked at how we got that so wrong, and taken some learnings from that. But sometimes these big stocks, you got to. It takes a different kind of nuance to find a mispricing, and sometimes you're looking for a differentiated view in a big stock that isn't there. And I wonder if that was the case there with Google, where we were just forcing a differentiated view when really we probably shouldn't have been doing that.
I think the two lessons from Google were, one is that all the bad news was in the price when we hit the sell button.
Yep.
And it was, everyone was looking. It was being defeated by AI, or the other AI, the Nvidias of the world and whatnot. Search may well come under pressure at some point, but it just hasn't happened yet, and it's had blistering results since. And the other thing was it was going through the legal stuff as well, and that was a big weighting on the stock, and that turned out to be absolutely just fine. So there was a huge relief. And the actual multiple, if you look through the bits and pieces of Google, the actual search business was on a really, I think it was something like you could almost get it down to 10 times earnings, depending on what you valued the other stuff to. So it had a lot of room to run once, the people got over the AI fears and the legal fears. And just quickly going back to the alcohol companies, I think it's we've seen this in a lot of those big high volume businesses. People who might remember Buffett getting into business with 3G and buying up the Crafts and Heinz, and so all these businesses that rely very much on huge volumes, they're really suffering. The price they're able to charge for their products is coming down, or the growth certainly isn't there. People aren't buying that sort of stuff anymore. Like a lot of that stuff is pretty much unhealthy stuff, whether it's cereals. My daughter puts everything on her vegetables. It's tomato sauce, which even just the smell of just disgusting. All these things, they're just not things that people want anymore. And I see it in my own kids. The attitude towards alcohol has completely changed almost. And you're seeing that ripple effect not just across directly to companies like Diageo, but even with our investment in Endeavour. People just aren't sitting in the pubs anymore drinking a heap of VBs with huge markups for the pubs. There's just so many other dining destinations. Families don't go to the pub so much anymore. So there's some mega trends, and when you are on the wrong side of those things and you think you're getting a cheap multiple, that these are reluctant to call Diageo and some of these businesses melting ice cubes, but they certainly have that flavour about them. The salad days are certainly over, but I would have said that for the banks 10 years ago.
I think we did. Let's move on to some fun stuff. What did we get right? Or where? Actually, let's make it more specific. Where did you make most money this year. Nath, you can choose your own funds or the portfolios.
Yeah, look, I don't know if this directly answers the question. I think it probably does, but and this is sort of has a whole bunch of lessons tied to these two particular situations, and one that John actually wrote up, lessons for recently, and the other one I have no doubt, Gaurav, you'll be writing up a lessons from at some point. But the two stocks are Mineral Resources and RPM Global. With that, completely different situations. RPM Global was the perfect stock. We did everything right about it. It worked out exactly, even better than we could have hoped. But the lesson is that it looked so easy looking back. Like you just had to buy it and hang on, and it just did everything you hoped. It was, maybe there was a slight slower period at some point, and the share price languished a little bit. But behind the scenes, when we got that into the funds, it was, I think, barely a $200 million company. And we have very strict liquidity constraints on our funds because they're listed ETFs on the ASX. So our liquidity rules are governed by the ASX, and they're extremely strict. And they get you every which way. They get you by market cap. They get you by how much cash you've got in the fund. So the more cash you hold, the more lenience you've got to buy some more liquid stocks. And they get you by how much of the market cap you account for. So it's really, really hard for us to buy the minnows. And so we had to work really hard to get RPM Global in, and it meant sacrificing some returns twice. There were periods where we had to hold more cash. So that was just sitting there earning, not even the bank rate. So I'm really glad it worked out, because the bet we were making was that it was worth holding on to RPM Global for the returns we get from that one stock than to not own it and then just be fully invested in two or three other stocks or whatever it was. And that worked out. So I was really, really happy with that. But there was also one point where we actually were forced to sell some shares when I think it was like $1.50 or something, $2 maybe. And that really hurts when it was our best idea, I thought, at the time. And to be forced to be selling your best idea well before the market's really cottoned onto it was really frustrating and hard. So it looks really easy in hindsight. And if you just read the material on the website, it just looks like one of those obvious ones where you just bought early and hung on. But the reality for the funds and the model portfolios was actually much, much more difficult. So I couldn't have been happier with that. And again, like we have to go into investment committee meetings with essentially board members to explain these decisions. So there was a lot more going on behind the scenes with that stock than what it appeared on the website. So that was great. The second one was Mineral Resources, where, in hindsight, obviously it would have been smarter if, maybe at $50 when it was just in free fall, if we just had it sold and just said, look, let's just watch from the sidelines until we let things settle down. But it's easy to say that, but there's just none of us could have imagined that thing was going to $14. And part of the reason I think it went to $14 was coordinated short selling. It was just, they all just piled in together, and they were banking on a capital raising, and there would have been a lot of those short sells that actually made money out of it, yet they were wrong. The stock's back to $50, and I guess the frustrating thing, but also it shows, I think, the strength of our analysis was that the margin of safety for us was always that we felt it had enough assets that even in a dire scenario, which we actually got as far as lithium was concerned, not with iron ore, which I guess was luck maybe. But lithium got way worse than what we ever imagined. But it actually did. It did sell the assets, some of the assets, not all of them, to get through, and it didn't need a capital raising after all. So a lot of that value is being protected, and now it's back to being an earnings story rather than the balance sheet story. But it's really difficult as a fund manager to go through those situations, but it's much harder to be in Gaurav's shoes, to be on the website with the sort of stuff that was coming out of this business on the front page of the Fin Review every day for 4 months, and the media still hasn't let it go. So I thought it was just an extraordinary effort by you, Gaurav. I haven't been through similar situations myself with stocks in the past when you, and not for that long either, to have a stock that was that long, the front page news, and everything was bad. Everything. I mean, seriously, when you're getting to the point where trucks are rolling over and the picture the one thing that made Mineral Resources great and makes it great is just their, ability to do complex projects.
Yeah.
And here we stuck, and that was really what, it was the balance sheet we thought had enough assets, and the fact that we thought these guys were great engineers, essentially. And they are. And that's what gave us the belief to hang in there while a lot of others quit and got out. But when you're seeing, when you think you've been through the worst of it and the legal stuff's come out and the impropriety by management and all the rest of it, and then it's one truck rollover. And it's like, oh, geez, it's just one in 18,000, iron ore deliveries. And then like the next week it's another one, then another one hasn't been reported. And then it was 6 or 7. Mm-hmm. But none of them were actually, like if they were flying down that road at 100 k's an hour and flipping, like that would have been, that would have been the end of it, I think, for me. But that's not what was happening. It was actually driver error, and they were really simple mistakes they were making on the sides of roads and stuff, and they were just rolling over on their side at very low speeds. But to remain concentrating on those facts and to hang in there and stick through it, just for anybody, it was a great effort to anyone who stuck through it. But I just thought it was an extraordinary effort by you, Gaurav, to keep people in the know with so much commentary and so many strong opinions about, even the morals of owning this stock given the governance issues. I thought it was an extraordinary effort by you. And I think it really shows what Intelligent Investor is all about. But we've essentially got our money back. Haven't actually made any money on the stock yet. But I think at cost, it was probably the stock with, other than stocks like BHP, where it's like 12% of the index, in terms of like what I think are real esoteric ideas, I think that's the most we've ever put into a stock at cost. And we saw it basically fall 85%. So to hang in there and have got our money back, I couldn't be happier with that.
No, I think there's more to come from that stock. If you've been reading our research, I think there's more to come. Appreciate the kind words. It was difficult, but also it was really a psychological game more than an analytical game. It probably deserves its own deep dive. We'll do a members only deep dive on MinRes in the new year, I think, because there are lots of lessons to take away. But one thing I was thinking about concerning MinRes was just people might be sitting there thinking, well, why didn't you pile in at $14 or $15? And it did cross my mind. But the reason we didn't was because as that share price fell, classic investment theory tells you the opportunity gets better. But when they have a giant pile of debt, as the share price falls, the risk actually escalates, because if they raise capital, if they choose to pull the trigger and raise equity, you just get decimated. If they had raised capital at $15 or even $20, that's permanent impairment of value. And that's the thing that really concerned me, that there was so much pressure on them to raise equity. And if it was just Ellison, if Ellison was in a strong position, that wouldn't worry me, because I know that guy and he's not going to pull the trigger. But he was losing influence on that board and he was sidelined. And a normal corporate chairman would have every day of the week fixed that balance sheet first and would have just pulled the trigger and raised. So that's why we didn't buy and filled the truck up at $14 or $15. It's because there is a world where a conventional management comes in and they just fix the problem, which was the balance sheet, and raise equity. And we get cleaned out in that scenario.
People might have seen in the media, I think it came out in the Fin Review yesterday, that corporate travel, no one knows what that's worth at the moment. It's not trading. And I haven't checked specifically, but I believe Bennelong might have had 10% of their funds in the stock.
Yeah.
And now they've essentially written it down to, close to zero. And that alone, that wipeout is essentially, I think their fund, which has been around for decades, is now underperforming since inception. So it's to me, portfolio sizing is really where the rubber meets the road in investing. Right. Yeah. It is the single most important thing, and there's so much that goes into it, so much that's psychological about being prepared to back your confidence, but the risk of being wrong when you're 10% plus in a stock, particularly as a professional investor, where your whole professional reputation is on the line, the business's reputation is on the line. Like who would want to invest with Bennelong at the moment after seeing the corporate travel stuff? of course, people are going to start asking questions about their risk management and their process and all that sort of stuff. And, in a sense, maybe it was just bad luck, but that's why we have diversified portfolios. It's why we didn't buy we bought some shares, I think maybe at $26, maybe.
Yeah, that's right, in the mid-20s.
But at cost position, I think at the maximum it got to was 8%, and normally I would keep that to 6, normally 6 to 7 for. Obviously it's different for different stocks. I mean, for Commonwealth Bank or BHP, the index weightings are so much higher than that's not quite the same argument situation. But to go beyond 8% for a highly leveraged, stock that, even though it had this incredible mining services business, but was still subject to commodity prices, I think that just would have been foolhardy, and we could have easily been wrong. And the debt was a problem, and maybe a huge capital raising was forced, and maybe the stock was only worth $20 or $25, which may not have been a mistake, but certainly the 7% we bought before that would have been
permanently impaired, I think is what you're looking for. Might have lost Nate for a second there, but lest we turn this into a MinRes retrospective. Graham, where'd you make your money in terms of personal portfolio or recommendation? What worked for you?
Well, I think the recommendation that worked the best was probably Gentrack. We bought it in late 2022 for $1.30 or so. And we were buying it because we thought it was undervalued kind of fundamentally, but also it was just being beaten down because of a really bad couple of years in its UK business. It had customers that were going bankrupt and all the kinds of things you don't want to see for a utility provider. But then the business kind of turned around over the following 2 years and shot up to $12, where we then decided it was too expensive and decided to sell. And since then, it's done exactly what we would, or what we expected to see. And it's now down at about $8. So we kind of made the money on the way up, locked it in at exactly the right time, and then got to watch it fall to, we're not necessarily good value today, but much more reasonable values again. So, I think Gentrack would be the one that stands out in my mind because we got it right on both the up and the down.
Well, selling well is just so satisfying, isn't it? It happens so rarely that you sell well. You're often, I think we're pretty good at buying. We often buy pretty well. But geez, when you get that sell decision right, it's just lovely. Good work on that one. Nick, have you answered this question? I can't remember now after all our...
I mentioned Allfunds. Another one I'd probably mentioned is Dick Data. And it hasn't shot the lights out, but I've covered the business for now about 2.5 years, and I think we started covering it at about $8, and then it sort of did nothing for 2 years because profits were sort of flat as the industry was sort of going through a slower sales period after a bumper COVID period. And now that's starting to turn. But I guess if I was going to pat myself on the back, it would be just to have the patience to hold throughout, because we didn't make any money on this for 2 years apart from the dividend, which is quite good. It's about 5% a year. But this year it started to do a lot better, and that's mainly just because the revenue growth that we're seeing last year has now been matched by profit growth as well. And I think the outlook for the company looks quite good from here. The directors have been buying on market. The one hiccup was David Dicker, the founder, left on bad terms and has sold all his stock. But I actually think that the management team that's remained is actually really, really good. Yeah. And they've got a lot of industry experience, and they own a ton of stock. So I still like it. But yeah, that was probably one of my favourite Aussie picks for the year.
Yeah, no, I did owe that as well. I like that one too. And I actually think him leaving may improve things, because I'd never liked their dividend policy, which I thought was too aggressive. And I think his absence might actually fix that little problem.
Yeah.
My favorite is, my best performing is no question. Minerals 260 has just been phenomenal. I mean, I was banging the table on that internally in meetings, but none of you wanted to make any money. So I think only John followed me into it. But I'd worked on the Bullabulling project. Well, not worked, but I had analysed that project when it was found by Norton Goldfields sort of 10, 12 years ago. So I was familiar with that project. When it popped up again, I could see that as an opportunity that I had better knowledge of it than other people fresh to it would have had, and And so I was prepared to put money behind that idea, and I wrote it up for members. I said it's a good idea. we couldn't put official buy on it because it's a little exploration business with no revenues, no prospect of revenues for the next 3 years, which is just not what members pay us to find. But that was just an exception. I always say that if you want to do okay, you got to follow rules. But if you want to do really, really well, you got to learn when to break rules. And that was a rule breaker stock that just has worked out so well. And I think there's more to come from them as well. I think this one is going to get into production and ultimately probably be taken out by a bigger company. But keep an eye on that one if you're not following it already. Now let's finish off, gents, with just give us something for the new year. Can we do a favorite stock for next year? Or is that too much? Nick, you want to start us off? Or at least something you're excited about for next year?
Well, I'm excited about how many opportunities we're seeing, particularly in high-quality companies. I know I've already mentioned that, but if I was going to go specific, it would be just the classifieds group, whether that's REA, car sales. They're not quite there, but they're getting a lot cheaper. These are high-quality businesses. The UK ones I've already mentioned, Auto Trader and Rightmove, they are there. They're now trading at 15 times earnings, I think, the pair of them. And I'm just most excited about that, and that if there's any hint of this, that AI doesn't live up to the promises or its potential, I think these stocks can do really well. So I'd go classifieds groups.
I'm also looking forward to that. I've been wanting to own those companies for so long and never have. So I reckon we'll get a shot at that. Graham, how about you?
I think I'll go with Helios. It's the dog of 5 years ago has definitely started turning itself around. It doesn't have any debt. It's operating in all these fast-growing niches like genomics, and I think that if it can get its labour and collection centres a little bit better operated, then there's quite a way to go for this stock.
It's going to become an ostrich.
An ostrich? Is that the one that sticks its head in the sand, or is that the one
that runs fast?
Oh, right, okay.
Turning from a dog to an ostrich.
I've never heard that.
I was wondering the same. I was like, the sand has something to do with this, but I don't get what it is.
Was it an emu? Maybe they run faster.
I just love that. The one thing we've never had is members or investors ask us for genomics exposure, and here we go. We're giving
now is your time.
We're giving you what you don't know.
Every childhood's dream.
Yes. Nathan, what about you?
Oh, well, as always, speaking of animals, I'm always praying for a bear market.
Yes, you are.
I've been disappointed for so long now. I'm beginning to think we're never going to have another one. So I've got a feeling I'm going to be disappointed in 2026. But just the last little bit actually has brought some very reasonable valuations to some very high quality stocks. And Nick touched on it, but just the fears around AI killing a number of highly profitable industries, where some of the highest value stocks have been for a long, long time. They've all come back to earth and they still pretty reasonable. So that's been great. And you see, yesterday was today with the Constellation Software opportunity. I mean, that's just a stock that's just absolutely rocketed for so long. I never thought it was going to come down, and yet here we are. And it's funny how if you invest for long enough, every stock becomes cheap at some point for some reason. So I'm looking forward to those general opportunities, and Nick on the international side's got his hands full because I think there are a lot more opportunities abroad than there are in Australia at the moment, not just for the fact that there's just a lot more stocks overseas. But I don't have any sort of individual stocks, but I think we've just seen, our funds have struggled for the last 2 or 3 years just against the index. We haven't had, a huge amount of mistakes, but I think this last little 3 or 4 months just shows you, and I've been saying this for a couple of years at least, that, in terms of growth and value and all that sort of stuff, it's all joined at the hip, and we don't really see the markets like that. But just in terms of value, I think value stocks have had 2 of their worst years relative to the index in the last 5 years. And when you miss that change, you can miss a lot of gains very fast, and you've seen that in a couple of our funds, just the outperformance in the last, basically I think we outperformed by about 10% in 6 weeks or something like that. But I think that turn is really a precursor to what's going to I think, drive markets over the next 5 or 10 years, because you just can't keep paying 40, 50, 60, 100 times earnings for all these stocks at some point, and the banks 30 times earnings and stuff. At some point, even if there's nothing wrong with the earnings, people just get fed up because the stocks don't go anywhere because the earnings just can't justify those valuations. So for the next, not just next year, but I think for the next 5 years, I think finally value investors are going to have a much better fist of things, and our model portfolios and our actual funds are very well placed to capitalise on that. And we're in a really good spot.
Yeah, I think that's already happened. I think the traditional value stocks, boring defensive businesses are now looking quite interesting and make up a lot of my own portfolio. I mean, things like Woolies and Sonic and Dalrymple Bay and EVT and coal. I mean, coal is looking, it's probably, we'll never see the screaming opportunity that we saw in 2021, 2022, but it is now looking really interesting again. And those are the sort of high cash flow, low volatility, very dull stocks that I think are getting completely thrown out and mispriced at the moment. There's plenty of opportunity still. So I'm looking forward to those companies making gains and proving that value investing still works, which I think most people have convinced themselves it's dead.
Yeah, as a personal investor and a professional investor, this is not what I got in the game for. to be buying Woolies and Sonic Healthcare and all these sort of stocks, but you just got to go where the value goes, and you just really got to sacrifice excitement. I'm not excited about small caps as what I was, and RPM Global and a lot of these companies are getting hoovered up and disappearing from the index. From the market. But if you actually just want to make money and you want to outperform, then these stocks look as good as they have in, some of them in a decade or more.
Right. So we've got a couple of more weeks of writing ahead of us, but I think you'll start seeing the schedule start to slow down, and we take a bit of a break over Christmas, New Year, but we'll be back in January with members-only podcasts and, of course, StockTech. We'll take this chance to thank our producer, Greg. Nick, you don't produce anything. Our producer, Greg, who makes us sound good every time and has got us all organized, and we couldn't do it without him, so thank you, Greg. Gents, been a pleasure. Another excellent year. Great working with you all. We've still got our pub day coming up. We're going to try dessert beers, I think, is the go this year. So no one is buying beers, but we're going to put a dent in those numbers, I think, for one day at least.
It shows the limits of AI when I'm interstate and can't participate.
We'll sort you out. It's okay. Thank you to listeners, and thanks to members in particular. It's we work for you, and we always enjoy doing so. Nath, boss, good to see you.
Thanks,
we'll see. We'll hear from you in the new year. You're on the pod, hopefully. Nick, wonderful to hear from you again.
Thanks, guys.
Graham, we're going to see you shortly. He's going to be gracing the shores of Sydney very soon. We'll see you soon, Nick. Graham, damn it, Nick, why am I keep saying your name? And for everyone else, thank you for listening.